The question that I had for today was, I'm getting the sense that the interest rate is not going to matter. So I've been chasing lower interest rates, refinancing, and that's the game that I've been playing. But the sense that I'm getting from you is that whatever interest rate that you're at, it's not going to make any bit of difference. But is that entirely true, though? Because what your system is based on extra cash that you're going to have on the sidelines to be able to pay down the loan. Can you talk a little bit about that and clarify that for me?
Sure, I'd be glad to. So the interest rate is a factor, but it is not as big a factor as you might think. All right. So what we want to do is figure out based on what monies that you have to work with, Yasser, then by knowing that, then you'll know how you want to manipulate the principal payment. So, for instance, I'm talking to a person who runs an AIG office. I mean, it's kind of a wonder kid. I mean, very young, but I mean, at the top of his game mathematically, and he understands money. Okay. And somebody brought me into his office so he could debunk this program. I didn't realize I was being set up. But when I went into his office and started talking to him about the program, within a half hour, he leans over and says, "How can I get this program?" Because he began to see it. Because being in the position he's in, he gets bonuses. So if he gets his bonuses, he says, all right, and he's getting ready to get a mortgage. And they said, oh, at the time, a great interest rate was 3.7, 3.8 at that time. So when he gets his loan, he says, you qualify for 3.7. He tells the lender, says, that's great. May I have 4.25, please? So they said, oh, you didn't hear us. We offered you 3.7. He says, well, I heard you very well. I would like 4.25. Why? Because by having that higher interest rate, it lowered his principal to the point where, based on the bonuses he receives, he can get deeper and faster into his amortization schedule, closer to zero payments, using his bonuses, because now he's manipulated the principal payment to be smaller. Okay, so let me give you just another quick example of that before we go on here. All right, so I'm going to put this on the screen, and we're going to duplicate this, pull this up, and we're going to put $100,000. Okay, we're going to go back a few years, folks, when you could get a decent sized house for $100,000, but the interest rate was 12% for 360 payments. And this goes back a few years ago. And there are people who are alive today that said, yeah, back in, the 70s, you could have a 12% interest rate and you were lucky to get it. Okay. So now by looking at this, so we're going to calculate that for 30 years, our payment is $1,028.61. So if we take a look at this, folks, for 30 years, if we keep this loan for 30 years, a $100,000 loan would cost you in interest cost $270,299.60 in interest alone. Total interest paid as a percentage of principal, Yasser, 270.30%. 270%. How do people get away with that? So here's what's going on. When you take a look at payment number one, look at this. And folks, if you've been in this room before, you're jumping up and down. It says, when we had a 12% interest rate, why didn't we know this way back when? Because look at the tiny principal payments. The first principal payment here, Yasser, is $28, $28.61. First interest payment, $1,000. So can you imagine paying back a loan where only $20 to $30 was going on principal, but you were giving the bank nearly $1,000 each month for the privilege of paying down your loan by $28? That's what was going on. But if you knew what we were talking about today, folks, listen, what would we have to do if we pay payment number one? What would we have to do to get rid of the interest payment on line two? All we would have to do is make our first payment and give the bank an additional $28.90. And you knock out one payment and you save $999 in interest you don't have to pay. So if we go down the line 12 and we add up all the principal payments for 1 year, that's $362.85, $362. So if you make your mortgage payment, come up with an extra $362, you can knock out 1 year's worth of payments and save $10,983.78. But the folks are saying, but Don, look at the interest payments. Look how high they are. And here's my answer to that. Interest payments you skip don't matter. Interest payments you skip don't matter. I don't care what the interest payment is if I'm skipping them. If I could take $362 and knock out 1 year's worth of payments and save myself all of that interest, it's knowing how to read this thing. So folks, we need to stop looking at what we borrowed and the interest rate and start looking at the interest cost and see how we can manipulate it and to make it work for us, because we can save at the same rate that the bank is charging us. If they're going to charge us $999.71 so that we can give them $28.90, well, let's give them the $28.90 early so it benefits us and makes it impossible for them to charge us $999.71. It's as easy as that. Now, all we have to do now is put all of this in an AI system, artificially intelligent system, so that now you can save the maximum amount of interest per dollar applied. So you're always getting the biggest bang for your buck. Yes, sir. Does that help?
It does. I mean, so you're definitely going to be paying them some interest. It doesn't, that money, in retrospect, if I would have known this, rather than refinancing, that extra money that I paid to pay, get an additional 25 basis points or 50 basis points, I should have just made additional payments or, been on a system like this to be able to, that would have been much more beneficial, it seems, rather than decreasing my loan by 100 basis points even.
Well, Yasser, if we take a look at this thing and understand it the way that we should, when we refinance, most people refinance to a new 30-year loan. Most people do. So it's not the interest rate that is the most important factor in that transaction. It's taking what you now have as a principal balance and dividing it by a new 360 payments. That is the major factor in lowering your payment, not the interest rate. Does that make sense?
Yes, that's absolutely true.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.